On this historic day for the Fed, we look at QE2. Our next guest says the policy has been dangerous and unnecessary for the U.S. economy. Last fall, Columbia Business School professor Charles Calomiris was part of a high-profile group that sent an open letter to Ben Bernanke urging him to stop the economic stimulus. Professor Calomiris is with us now from Washington. Thanks so much, Charles, for joining us this morning. QE2, you wrote this letter back in November. 4 short paragraphs, short, sweet, to the point. Did QE2 go even beyond your worst-case scenario in what it's done so far to the U.S. economy?
No, I think it's pretty much worked out as I thought it would, which is it didn't have an effect really on long-term interest rates. It has unfortunately goosed up the Fed's balance sheet even more, so now we're at $2.7 trillion, which makes the climb down for the Fed, which is now so obvious and necessary to prevent inflation risk going forward, more difficult. So I don't think QE2 was the end of the republic or the worst disaster that could befall us, but it's just made the Fed's job going forward more difficult unnecessarily.
Charles, I have to jump in here and just ask you a question. You're saying that absent QE2, we would still see 10-year treasuries at 3.3% where they are right now?
Well, remember, treasury rates, for the most part, since QE2 went up, long-term treasuries. So the argument that the Fed was going to be controlling long-term treasury rates actually has completely been, I think, discredited. In fact, the timing of QE2 coincided with a reversal in long-term treasury rates.
But the argument has been that rates dropped in the anticipation of QE2. We saw, from Ben Bernanke's speech at Jackson Hole last August, Treasury yields dived, and yes, they've been creeping back up, but they haven't. I mean, the backup in Treasury yields has been relative to where they were significant, but historically, certainly not dramatic.
Yeah, that's not the way I look at it, Eric. I mean, I think what you saw happening from May to August of 2010 was a series of very bad news. We had a lot of bad news from May to August, and the long-term treasury rate is not determined so much by the Fed as it is by market perceptions of economic news, which was very bad. And of course, that's what got Bernanke going with the idea for QE2. Then that news, a bad news grouping from May to August sort of disappeared. And if you recall, by about November, we were in a very different situation. That was when we wrote our letter because it was obvious to us that it was time for the Fed to climb down from QE2. And of course, many people in the Fed system believed so too. And I think actually part of what the Fed's chairman's job today is to restore more unity to the Fed. The Fed has not been speaking with one voice. We've had some very intelligent commentaries from Fed presidents that have been contrary to what the chairman has been saying. And I think that part of what the chairman's trying to do right now is restore his position as a spokesman for a unified Fed with a unified vision where he's going to start turning attention to the mission of preventing an acceleration of inflation. Now, I don't think he's going to do that all today, but I think that that is really a mission. While he's attacked from all sides, he's being attacked. So today is a show of force. Having done enough. I think it's the beginning of trying to reestablish some unity of message and position the Fed toward the real risk going forward, which is inflation. And that's coming from a lot of different places. It's coming from commodity price surges. It's coming from fiscal problems of the U.S. And it's coming from a huge Fed balance sheet, which is going to be very hard to control the money multiplier as we get it firmly into the recovery and expansion.
Well, Charles, you flagged months ago inflation as the big tail risk in QE2. How would you explain then, and particularly inflation expectations, and we've seen one-year inflation expectations rise quite dramatically. How do you explain the decline in 5- and 10-year inflation expectations, given what you just pointed out, the rise in commodity prices, the rise in gas prices? And maybe that works to Ben Bernanke's advantage.
Well, first of all, I'm not sure over what time frame you're talking about a decline, but I would say that the 5-year expectations since the origin of QE2, I think, have inched up a little bit. But
no, I was thinking very short term, but keep going. I'm sorry.
Yeah, I think they've inched up a bit. And my view is that they're going to rise even more. The other thing to mention, of course, is which inflation measure you're looking at. The inflation measures that are most tracked include sort of phony prices like the imputed housing price, which really shouldn't, in some sense, according to some economic theories, even be part of the index. So when you look at excluding that, we're already in a higher inflation regime than has been recognized by the official numbers. And I think the acceleration in commodity prices has everyone, especially me, very worried. So I think the Fed is now in a position where the depreciation of the dollar, which is, of course, affecting import prices, the acceleration of energy and food price increases are a worrying sign. And then, of course, in the background, they've got their own balance sheet of $2.7 trillion. And the problem is, what happens when banks start lending and the money multiplier gets restored to a normal level? How does the Fed control the money growth that comes from that? And then, how does the Fed deal with the fact that the U.S. government's out of control in its fiscal policies, and we have a potential for S&P downgrading the U.S. Treasury? Yeah. So we have a lot of risks for Bernanke, and I think what he's got to be turning toward, and I think it must be in his view, is turning toward reestablishing a Fed focus, not necessarily today, but in the next few months, on how the Fed is going to deal with inflation in a way that they can speak with one voice, which they have not been doing.
Charles, we thank you so much. Charles Calomiris, we're going to be listening very closely to clues from Bernanke today, obviously on inflation, a big theme, as Professor Calomiris just pointed out.